So let's just get right into it. Why on earth would someone completely overhaul their portfolio for a recession that might be, what, 2 years away? Or, hey, it might not even happen at all, right? That's the core question we're digging into. Now, I gotta be super clear here. This is not financial advice. Not at all. What we're doing is breaking down the thinking behind a big strategic move. It's a system for dealing with a future that looks, well, pretty uncertain.
And boy, is that future uncertain. I mean, look at this. On one side, you've got experts saying, get ready for a massive rent boom because of a supply shortage. But then on the other side, you've got people who are just as smart pointing to this nearly $2 trillion maturity wall, basically a mountain of commercial real estate debt that's coming due, and they're screaming crisis is coming. So when the pros are literally on opposite ends of the field, what are you supposed to do? This is the real problem, you see. You just can't trust anyone's crystal ball.
Which, leads us right to the big question for all of us. If the forecasts are basically a 50-50 shot, how do you get ready? The answer isn't about hunting for a better fortune teller. Nope. It's about building a better system, a better framework for making decisions, especially when the road ahead is this foggy.
Okay, so let's just get one thing straight right off the bat. The whole point of smart investing is not about perfectly predicting the future. Anyone who tells you they can is selling something. Trying to time the market perfectly, it's just a recipe for stress and, let's be honest, for being wrong most of the time. It's a strategy built on hope, and hope is not a plan.
No, the real goal, the smarter goal, is to prepare. It's all about building a portfolio and a strategy that are tough, that are resilient, one that has a plan for a bunch of different outcomes. So whether the market soars or tanks or just goes sideways, you have a playbook. You stop reacting to every crazy headline and you start executing your plan.
All right, so what does a system like that actually look like? Well, here's the blueprint. We're going to call it the 4 pillars of investing. Think of it as a systematic way to look at the markets that helps you take the emotion and the guesswork out of the equation. It gives us a framework for understanding the why behind a move, the when to actually pull the trigger, and the how to do it right. So let's break them down.
First up, Pillar 1. We're starting way up high at the 30,000-foot view. This is all about sovereign fundamentals. See, before we can even think about analyzing a single stock, we have to understand the economic weather system it's living in. We got to look at the financial health of the entire country.
Yeah, think of it like this. Every single company, I don't care how cool or innovative it is, operates in the shadow of these huge nation-level forces. We're talking about things like the national debt, demographic trends, and government policy. These things create these powerful currents, either headwinds pushing against you or tailwinds at your back, that can affect pretty much every stock in the market.
You can boil it all down to this incredibly simple but powerful formula. The long-term path of an economy, it's almost entirely shaped by 2 things. Its people, that's the demographics part, and the decisions its government makes, that's the policy part. These things are like slow-moving giants, but they absolutely 100% determine the long-term direction of the ship.
And here's a perfect example of what I'm talking about, how these fundamentals can totally change over time. In the past, if you looked at the biggest spikes in U.S. national debt, they were almost always tied to one thing: war. But today, the main drivers are mandatory spending programs like Medicare and Social Security. Now, look, this isn't a political statement, it's just an economic fact. It's driven by demographics, an aging population, and policy choices made decades ago. And that creates a completely different kind of pressure, a much more constant pressure on the entire financial system. Okay, so if the fundamentals give us that big picture, long-term story, how do we know what to do right now? How do we figure out the when? Well, that brings us to Pillar 2, technicals. This is all about listening to what the market itself is telling us, looking for clues about where the money is flowing and what might be coming next.
You've probably heard this quote before, and it's a classic for a reason. Our fundamental analysis, our homework, might tell us a company should be worth more. But the chart, the price on the screen, that tells us what millions of investors are actually paying for it today. The chart has the final say. It's the sum of everything. All the information, all the hope, all the fear, all priced in real time.
But trying to read a chart can feel, a little intimidating, right? So here's a great way to think about it: the Seinfeld analogy. Think about the show Seinfeld. Every episode is different, but they all have these familiar themes, these recurring patterns, right? Jerry's got some weird dating problem. George is about to get fired. Kramer's got some new get-rich-quick scheme. Well, the market is kind of the same. History doesn't repeat itself perfectly, but man, it sure does rhyme. Because human emotions, fear and greed, they never change. Technical analysis is just the skill of spotting those familiar plot lines while they're happening.
And one of the absolute most important patterns you've got to watch for is something called sector rotation. This is when the big players, the smart money, start quietly moving billions, with a B, of dollars out of some parts of the economy and into others. It is a massive tell. It's like a flare going up, a huge warning sign that they're expecting a change in the economic weather. And they're usually doing it long before you read about it in the news.
And here we go. This is a perfect picture of what that actually looks like. You start to see money pouring out of what we call cyclical sectors. These are the companies that do great when the economy is firing on all cylinders. Think flashy tech stocks, car companies, luxury goods. And at the exact same time, you see that money flowing into defensive sectors. These are the companies that sell stuff we all need no matter what. You know, toothpaste from Procter & Gamble, medicine from Johnson & Johnson, or the electricity from your local utility. When you see this rotation happening, it's a classic sign that investors are battening down the hatches for a storm. All right, so we've got our why from fundamentals and our when from technicals. Now we get to the last two pillars. And you could argue these are the most important ones of all, because they're all about the how. How do we actually put our money to work? And maybe even more importantly, how do we manage our risks so we don't get wiped out? This is the practical, all-weather playbook for actually doing it. I love this quote because it really gets to the heart of what risk management is all about. It's not about being a pessimist. It's a trade-off. It's a calculated decision. You might consciously decide to give up the chance for that absolute home run, grand slam return in exchange for something that's way more valuable, protecting your money and getting some peace of mind. You're basically buying the ability to sleep tight at night no matter what the market throws at you tomorrow. So this whole defensive playbook, it really just boils down to these three core ideas. First, you hedge your bets. That just means you don't put all your eggs in one everything's going to be awesome basket. Second, your number one job becomes capital preservation. It's suddenly more important not to lose money than it is to make it. And third, it all comes back to that central theme we keep talking about: prepare, don't predict. Okay, we've gone through the 4 pillars of the framework. So now let's put it all together and see what this kind of strategic shift actually looks like. We're talking about moving from a portfolio that's basically built on hope to one that's built on a real, actionable plan. And this right here, this is the map that guides that shift. You see, the economy moves in cycles, and different kinds of companies do better in different phases of that cycle. When things are great, in a full recovery, aggressive sectors like tech and financials are usually leading the way. But as the technical signals, like that sector rotation we just talked about, start flashing red, the playbook tells you to start moving your capital into more defensive zones. You know, companies that are less tied to the ups and downs of the economy, like consumer staples, healthcare, and utilities. Okay, so let's make this real with an example. Here's what a pretty typical aggressive portfolio might look like. We'll call this one Portfolio A based on hope. You can see it's loaded up with cyclicals, tech, and financials. Now, this portfolio is designed to do amazingly well if the economy keeps roaring ahead, but its success is based almost entirely on the hope that the party keeps going. There's very little protection if the music stops. And now here's Portfolio B, based on a plan. See the difference? Following the signals from our fundamental and technical pillars, the money has been strategically shifted. It's now heavily invested in those defensive sectors we talked about: consumer staples, healthcare, utilities. And just as important, look at that big 20% chunk sitting in cash and hedges. That does 2 things. 1, it acts as a shock absorber to cushion any losses, and 2, it gives you dry powder, capital that's ready to go, ready to buy great companies at a discount if the market does take a nosedive. And really, that's the big takeaway from all of this. That shift from Portfolio A to Portfolio B, it wasn't a guess. It wasn't a panicked reaction to some scary headline. It was the logical result of a system that you can repeat over and over again. By following these 4 pillars, you can build a tough, resilient portfolio that doesn't rely on luck or a crystal ball. It relies on a clear, unemotional, data-driven process. So I'll just leave you with this one question to think about. I want you to take an honest look at your own strategy, your own portfolio. Is it built on the hope for a single outcome? Is it based on trying to predict the future? Or is it built on a system of preparation, ready for whatever the market decides to throw at us next?